The way that I'm trying to frame with this article, the future of options is that it's a new way to tokenize strategies. It's a limitless, boundless market in a way, because we won't run out of things to arb, things to edge out with options. Some players that don't want to touch options but say, I'll lend to market makers. They make 50% per year. I'm sure they're happy to pay 10% APY. That means that now you can lend to Panoptic. The rates will be predictable, similar to Morphos, but now you can arb the rates. You can borrow on Panoptic, supply on Aave, if the rates aren't aligned, or if there's a lot of yield on Panoptic, and borrow on Aave and supply on Panoptic.
How customizable is Panoptic V2? Can you take your Uni-LP position, regardless how concentrated, regardless the range, regardless the asset, and can you use that to find your customized perfect solution on Panoptic?
Some players that don't want to touch options but say, I'll lend to market makers. They make 50% per year. I'm sure they're happy to pay 10% APY.
Welcome back to episode 82 of the Odyssey Pod. Today we are joined by Guillaume Lambert. I think a lot of people are familiar with you and your X account, at least those who have been around in the industry for a couple of years. You have been one of the OGs to write, tweet, and talk about concentrated liquidity provisioning, LP math, both for Uniswap v2 and Uniswap v3. And now you're building Panoptic, which is an options protocol built on top of these liquidity provisioning paradigms. So thanks a lot for coming on. How are you doing?
Hey, very good. Thanks for having me, Max.
Can you give us a brief background how you ended up in the industry? I know you have an academic background in physics and biophysics and math. So what drew you into crypto?
Yeah. So again, my previous career, I was in academia, did my undergrad in physics, PhD in physics. I did 3 postdocs. So this is kind of the traditional way when you want to go from, being a student to be a professor. I was lucky enough to land a job at Cornell University in the applied physics department. So, and then the research I was doing was in biophysics. So all of that time, I was not initially involved in finance or options or anything related to anything besides physics and biophysics. But it turns out that, again, through my career, I always had to be at the forefront of latest advancements, the new microscopes, the new techniques, I was doing cloning even, like new cloning methods and DNA sequencing methods. That made me kind of always on the lookout for new cool things. And Ethereum came along. I knew about Bitcoin, was not that exciting to me, but Ethereum made sense to me. Again, world computer, I think is a good way to describe this, but it's that decentralized compute that you can quantify the value of. Yes, you can send transactions, but now you have kind of a compute behind it. So I was following Ethereum from a distance, started to learn again 2015, 2016, that it's only in 2017 when I really got into it, where I got my first Ether, did some CryptoKitties breeding back in the day. And just from a distance, hey, this is cool technology, not necessarily related to my research, but still very something that I enjoyed kind of following along. With that, I came acquainted with MakerDAO, with Uniswap v1, was liquidated on a CDP on MakerDAO, I think in 2018 during one of the crashes. And I deployed pools on Uniswap v1. So at the end of the day, I was kind of just dabbling along, doing something that was kind of cool, but not necessarily like career changing. With Uniswap v3 and with COVID, I guess this was in 2021, but a lot more time on my hands. The lab was shut down. So again, spent a bit more time studying Uniswap v2. But when v3 came out, very quickly jumped in, tried to LP, was doing it in v2 and v1, but LP and v3, choose a range, did like what a lot of, again, even the listeners are doing, where you choose a range, walk away for a bit and come back. And I wasn't even sure if I made money. Like I look, okay, this is how much I put in, this is how much I got out with some fees. But if I sat down, like pen and paper in hand, and decided, and we figured out, I lost some money. It wasn't that clear why. So that kicked off how can I actually approach this a bit more scientifically. Probably in the summer of like 2021 was when I did this a little bit more seriously. First article I published in June 2021 was Uniswap LP positions are like selling options. And the convexity, the shape, the way you manage this was very options-like, not just because I felt like it, but the math told me so. The fees and how of that impermanent loss management is quite simply solved if you look at it in terms of options. So this was getting a bit more serious. I wrote probably 5 or 6 articles during that year about LPing and AMMs and Uniswap. And when I got the opportunity to not just publish this, but work on these ideas and make them into a protocol. This is when I also was nearing tenure where I would renew and get tenure or not. And I had 2 choices, if you want. One is spending my time at the same place with the same people for the rest of my career, or do this crazy new DeFi, decentralized blockchain startup world. So again, chose the startup, and that kind of made it so that I could do this full time. And yeah, every day that I still code a lot. Every day that I code, every day that I work on the UI, I use my physics background, so it's extremely useful. So again, I'm still a physicist at heart. I just apply my skills to DeFi and option.
What got you into LPing specifically? Just the more mathematical aspect of it compared to like optimizing for lending rates, or I mean, back in the days when you got into DeFi, there were a lot more wild and like unregulated and Ponzi-esque things to farm. So I mean, you really must have had a passion for LPing for the sake of itself to end up in that niche particularly, right?
Yeah. I mean, a lot of what people do, which is just a lot of what people do on chain trading, spot trading, trying to be directional. This is fine, but this is not what I do in TradFi. So again, I was trading options, selling options as well in TradFi. Started a bit prior to GameStop mania, but this is what I like. It's a high risk but consistent reward when you sell options. And when I was LPing, I felt the same way. All right, I do have risk, but I get paid for that risk. And trying to lend is too static and boring. Trying to predict the market and trade directionally is also too dangerous for me. I'm always wrong. But that LP positions options in TradFi is quite a good happy medium for me. You do have a lot more data. You do have a lot of things to monitor, but you get paid. You have this kind of reward at the end of the day. Not because you're right directionally, but because you set up the trade correctly. So LPing was in V2 and V1 of Uniswap quite fun to do. V3 with the concentrated liquidity opened up that new window, and I still do this now. And selling options on Panoptic, and we'll talk about this, is providing liquidity. So this is all I do. I'm being option spilled in TradFi, and I do this as well in DeFi. So I have, even though we can still do a lot more now in DeFi and perps trading. Everything I do is all options.
Can you walk us a little bit through the basic math behind Uniswap, both V2 and V3? And what did you observe studying these topics that ultimately led you to the opportunity you identified when building Panoptic or deciding to build Panoptic?
Yeah. So we'll start with V3 and use V2 as an edge case to it. With Uniswap V3, you provide liquidity to a price range, and you say between 1,500 and 2,500, my liquidity will be active, and you earn fees if there's any amount of trading between these boundaries. If you're out of that range, you earn no fee, but also your LP positions composition will change. If you have 2,500 to 1,500, if you're above the range, you're 100% stablecoin. And that's just the nature of the beast. You start in the middle, you outside the range, you're 100% stablecoin. If you go below the range, you're 100% ETH or the risky asset. That's a payoff, and I don't know if it's mirrored correctly or not, but that's a payoff that looks like flat on one side and a slope of 1 on the other side. And that's a covered call payoff. If you go on, again, the Black-Scholes or the math behind options pricing, this is a covered call payoff. And if you're wide, there's some curvature between the two, but if you're very narrow, it's like a covered call payoff at expiry. So just the shape of the payoff, where the risks are. Technically, if you go above and you're in still stablecoin, there's no price risk. You just hold your stablecoin. It's not earning anything, but at least you don't have any risk. And if it's below, you have all the risk. So that's the difference between which side you are. The difference between how you manage the risk is quite options like, because the payoff is like an option. And
But
if you go,
if you're looking at the covered call payoff scheme, I'm just trying to pull one up while we're talking about it. Is that a linear payoff, or is it convex? So is it only delta exposure, but is it linear And is there like exponential exposure when the price is changing? So is it a linear curve or is it changing? And maybe you can break down the basic of the Greeks in options as well.
Yeah, of course. So that covered call payoff that you see is can't like a hockey stick way, but you do have it's a payoff that's not linear. If you were to trade perps 100x or 0.5x, price goes up, you make money. Price go down, you lose money. Here, the covered call has a cap, and technically, the price could go to 10x, and you don't do 10x, you just do 1.5x or 20%. So you're capped on the upside, and technically, you miss out on gains. And that is what makes it convex. The price goes up by quite a bit. Your return is less than that. And that is expiry. It's very, very kink-like and sharp in terms of transition between you make money or you own the asset or you just have a stable payoff, which is stable coin. But if you're wider, then you have some curvature and it's not as strict as up one way and flat the other way, but there's some curvature to it. And that slope is also quite convex. So the price goes up by $1, you make 50 cents. Goes up by another $1, you make 25 cents. So that whole diminishing payoff, if you want, diminishing return, is making it a short convexity or short gamma, or the you make less. And that should be a pretty bad deal on its own. Yeah, I want to get all the profits. So the way that you balance this is that, yes, the price goes up by $1 and you make only 50 cents, but you get paid some fees. Maybe you get paid 10 cents. So you recover some of this. And if the price goes down, maybe you get paid more and more. But that short convexity is a deal that you make, which is I'm going to give out all of the future profits for a steady stream of return, which is that fees that is collected. And in Uniswap, it's quite easy to see the difference with that value prop, because in range you make money, out of range you make nothing. And you do get a diminishing return. You are selling into the rally and not necessarily making all the money you can, but you can get paid. So that payoff that you see is a at expiry payoff. It's quite similar to a very, very narrow position on Uniswap. You can go from 2000 to 2010 in terms of price, or 25 or 25.10. So that very narrow payoff is like a covered call expiry. But if you're wider, it's similar in terms of risk as a covered call 7 days from expiring, or a covered call 30 days from expiring. And the wider you are, the longer it takes to go from fully owning the asset to fully being sold into into USDC. I'm sorry. So that width, in terms of like the convexity terms, is the gamma profile is shallower when you're very wide, quite a lot of risk when it's very narrow. And if you think about Uniswap V3, the limit where it's extremely wide, full range, this is the V2 payoff. So what I tell a lot is that the width of your LP position defines a gamma profile, and it's a bit abstract, but it defines a time scale as well. If you're very narrow, you'll leave in an hour, maybe. So this is like an hour, option that's an hour from expiring. If you're very wide, you can leave after 6 months. So technically, this is an option, a covered call, 6 months in the future. And the case of V2, which is full range, it never leaves the range. So it's an option that expires infinite time in the future, or years and years and years. And each has its own risk reward profile. V is maybe too boring because it's never leaving. You always get paid. You have this very, very smooth transition. But when you are narrower, it could be 10% plus or minus, 20% plus or minus. This is like a weekly. You should expect to only manage this every few days, or maybe every week, as opposed to every minute or every day, or in V2 style, never ever. So it's all a trade-off. But the shape of that payoff is what I have in mind when you go and do the math. And looks like a cover call, but then the key point is that the width of your position is a time to expiry type of replication.
Would you say that there have been right and wrong ways both to understand but also to implement LP positions and rebalancing and like setting a range? I would say in the DeFi dojo there have been tons of discussions over the past couple of months on how to actually view LPing. Like, is it a tool to generate yield, or is it more of a tool to express an opinion on an asset you would be willing to buy at a certain price or sell at a certain price anyway? And then you basically average down or like average out when selling and earn a little bit of yield on top of that? Or how would you say, also both from a personal use, but maybe from wallets you've followed and studied on chain, the people who have been successful, however you want to define that, with LPing, how have they used that like primitive to outperform the market?
Yeah. And I'm asking Masha these questions also quite frequently. The nature of Uniswap is a bit constrained because you have a covered call payoff. And technically, you make money if the price goes up. You make less money than holding the asset, but that's the thing. You make money if it goes up, and you lose money if it goes down. This is a covered call payoff. And if you talk to any options trader, yes, they may sell covered call, but they sell puts. They buy options. They can do a lot more strategies than just selling or participating in a single instrument. If I ask a market maker, could be Susquehanna, Citadel, anyone on their Jane Street, would you trade only calls? And they say, hell no. I need everything to my arsenal. Not just calls and puts, but then hedging tools and stuff. So at the end of the day, when you look at just purely Uniswap, you're limiting yourself to just single strategy, which is selling a covered call. If you do with options, yes, you sell covered calls for a specific purpose. But if you're a market maker or if you trade options, I mean, the way that I was doing it, and I'm doing it on Panoptic, you don't necessarily do directional bets. You harvest the yield. As you mentioned, the two sides is, I think, much closer to harvesting the yield. If you want to express yourself directionally, that's fine. But the key point is to harvest the yield. And what's missing is that if you only sell covered calls, you'll always lose money if the price goes down. It's a positive delta. It's a bullish strategy. Any bullish strategy in the bear market will lose money. There's no way against this. However, you can create delta neutral positions or even negative delta, bearish strategies, still using an Uniswap position as the core primitive, but you short the asset. You borrow some of it. You can short on Hyperliquid, for instance. So when you transform a covered call, which has this bullish outcome, you can create a straddle, just selling a put, selling a call, or selling a call and only buying half of the contract's value. But you can create something that's delta neutral. So you earn yield if the price goes sideways. If it goes up by a lot, you lose. If it goes down by a lot, you lose. But if it stays within the range, you can actually be net positive. And your goal is to collect that fee. You start with some funds, create a neutral. This is what I would do. But if you have no bias to the market and you say, hey, maybe I want to collect some fees, could be like 50% per year, depending on how you manage this, you need to offset the risk. And you don't want to be directional, you want to be neutral. So the missing maybe piece of Uniswap LPing is that you have to do this hedging off chain, or you do it in a different protocol. You can borrow on Aave some USDC or some ETH and then supply your own USDC, and that will create a delta neutral. But if you just do it with going out, buying the token, supplying your own ETH, you'll start with that maybe paradigm of losing money if the price goes down because it's a bullish strategy. And with Panoptic, we've identified this maybe as the biggest missing component of a mature options market. No one can only sell calls. You need to sell puts and do everything else, including buying options. And now, at least on Panoptic, we still deal with Uniswap LP positions. But then we now have this kind of more rich diversification of strategies on top, not just selling calls, but then now buying calls, buying puts, selling puts.
So there have been a bunch of protocols that have attempted to eliminate impermanent loss or to kind of simplify LPing both across V2 and V3. Some that are coming to mind are yield bases and gamma swap. I do think that there have been some prior iterations in the past, but I do think that these two are the ones that are still somewhat relevant today. Can you elaborate a bit on how Panoptic's approach is different from their approach? And are you able to explain whether these other approaches have been successful in their regard or anything that they are missing to fulfill what they're claiming to do?
Yeah, at least the I'll start with maybe yield protocol. Again, Michael Agorov, also a physicist, I think he gets like the risk profile. And if you just start with LPing, they're doing a lot of Bitcoin based LPing, but you can get wrecked if the price moves the wrong way. And impermanent loss is that quantification. Whether you held or you swap to get in the position, how bad is your P&L now because the price has moved? And the yield basis method is to be delta neutral. In a weird way, they borrow the USD, the curve USD, but they borrow one side of the asset. And now they have a debt that's half of their value. And they supply some Bitcoin, which is their own. But because they borrowed, this is what I mentioned earlier, they are changing the shape. It's a neutral, delta neutral strategy. And the yield protocol makes this rebalancing. So price goes up, technically you need to buy more. You buy more. If the price goes down, you need to short more. So you are doing a continuous delta hedging strategy that is what 95% of options traders do. They need to nullify their deltas. So it's a built-in method. They use Curve USD, they use the pool pairs, but it's enshrining, if you want, delta neutrality at the protocol level. And they are making the rebalancers, I don't know how they call this, but there's a role for people that rebalance the pool so that users don't have to go and buy and short or do something with it to win self. But that's kind of the right decision. If you're providing liquidity and you don't want to get exposed to price moves, but you want to maximize the returns just by pure profits from the fees, then you have to be delta neutral. This is yield basis. And again, they don't quite get the options lingo there, but they would be selling straddles and they would be delta hedging it. You can do this on Panoptic by clicking sell straddle and delta hedge, but in that case, it's the whole protocol that kind of enshrines that process. Gamma swap is a little bit similar to Uniswap, to Panoptic in a way, but they take V2 style full range liquidity positions. That's on Uniswap now, and then you can short them, or you can kind of borrow the position, unwrap its content, and then pay it back at a time later. So we do a similar thing with Panoptic, with Uniswap LP positions, but it's concentrated. But if you have the initial view of providing liquidity is like selling a covered call with that type of payoff, if you short that instrument, any instrument that you short and you have the payoff value, you just flip it around the right y-axis. So you start with something that was unlimited risk to the downside, something that has unlimited gains on the upside. You actually buy a call option if you short a covered call, if you short an LP token. So Gamma Swap does this at full range liquidity. So this is a option that you buy a call option, but that option expires infinite time in the future. So it's quite shallow in terms of like how quickly it moves. But if you do the same thing in Uniswap, in Panoptic, it's shorter. You have a more like shorter the payoff.
The issue in a sense with an approach like Gamma Swaps is that because it's spanning the entire range, it is just getting very capital inefficient, right?
If you wait years and years, then it's going to be efficient. But if you wait a few months, you may not get as much as you think, because the rate at which you accumulate premium is less efficient than if you're, even if like, instead of full range, if you're plus or minus 10x, which is, I don't know if the price of ETH will go to 20K or even 200,000 or $20. That range is still quite large, but it's already like four times more efficient than full range. So there is like, an efficiency that can be gained by concentrated liquidity. And instead of being an option that expires infinite time in the future, it's an option that expires 10 years in the future, which is still a long time, but it has more time to play out.
Can you walk us through the architecture and the mechanisms of Panoptic V2? I'm pretty sure you are very close to launching, so maybe you can already leak a walkthrough or a demo or a mock app.
Yeah. So the I don't want to get too technical. I can power the app, but the goal of Panoptic V2 is to improve on V1. So from user feedback from our own trading and optimizations, there were a few things that weren't efficient. We made it more efficient. And one thing that we've done, and that's something that could be like very interesting for you, for listeners, is that we do like flash loans in a way, but with options. Flash loans allows you to borrow funds, do a bunch of things in DeFi, and if you pay it back by the end, that's fine. You just pay a small fee or even zero sometimes. But the beginning to end is quite versatile. You can do anything you want by borrowing, and if you pay it back, it's fine. So we do the same thing. We do the same thing with options. You can mint as many options as you want, as big as you want. And if by the time you end the transaction, you're still solvent, then we let it go. We allow you to do this. You can control a quite sizable pool of options, and this is good for liquidations, for instance, or if you want to reduce the size, or if you want to change like multiple options, you can do a chain of operations. And as long as the last checkpoint makes you solvent, then it goes through. So that's a big UX change because you can chain operations. It's more gas efficient. You don't have to do 5 collateral checks for 5 different operations. It's all in one. And that's one example that the users might see a little bit more easily. Another one that was actually quite important is that we've built a lending protocol almost inside of Panoptic. And what I mean by that is that when you trade options, you can be fully collateralized, which is what Uniswap does, where you have to bring in your own coins. You have to provide exactly what you bring in, and that's going to be the capital you work with. But within Panoptic, you can borrow funds to tap into leverage. So we cap it at 5x, so it's that 100x leverage like perp style. But you can borrow a little bit of funds extra to increase the size of your position, increase your risk, of course. But now you have the ability to tap into leverage, which is what even folks like myself in TradFi, I do have access to 5x leverage through Reg T margining. And we offer this to users also. But there's a lending protocol aspect to it. Any user can come in and be a lender to market makers, and they don't have to trade options themselves. They can just deposit into the Panoptic protocol. We have a vault that will manage these kind of deposits a little bit like Morpho even and curators. But you can be a lender. And in V1, the rates were unpredictable, quite tied to volatility, and you could not necessarily kind of capitalize on bad rates. We've revamped this and kind of stole Morpho's adaptive interest rate model. So now we borrowed. We improved on one thing. We talked to the folks at Morpho and said, what would you improve? And the one thing that they said that sometimes when you don't interact with a pool for like a week, then it represses the yield in a way that takes like a week to restore. So we limit this. You can only do 1 day's worth of damage. Even if you do it 10 days later, 1 day's worth of damage, so you can restore quickly. But anyways, that means that now you can lend to Panoptic. The rates will be predictable, similar to Morphos, but now you can arb the rates. You can borrow on Panoptic, supply on Aave if the rates aren't aligned. Or if there's a lot of yield on Panoptic, you can borrow on Aave and supply on Panoptic. So that is almost like we built an entire lending protocol on top of our options protocol to satisfy leverage, but also now that lending protocol can play with Euler, Morpho, Aave, like in the same world because the rates will be kind of arbed. So that's kind of 2 big improvements that make the users that trade a lot will see probably a rate that's more predictable, but also better efficiency. But also some players that don't want to touch options, but say, hey, I'll lend to market makers. They make 50% per year. I'm sure they're happy to pay 10% APY. And now you have kind of a different kind of use base than just people borrowing money to whatever Maya mentioned in the real world.
So is that in some sense even comparable to what Fluid is doing, where you can use your LP position also as a collateral?
Yeah. I love the Fluid team. They started with a lending protocol and added swaps and a lot of different components to it. And I support this idea. This is the way that you make DeFi efficient. And yes, the LP positions can act as collateral. You can borrow against them. In our case, we do the exact same thing. You borrow to create LP positions, but now the LP position is part of your collateral. You can imagine borrowing more. So it's the same principle in a way. You still have your deposits that count as collateral, but your options, buying and selling options, everything that you do on Panoptic now can be used as collateral. And the flash minting of options allow you to do looping quite easily in a single transaction, for instance. So that's also something that you can do. But yeah, the Fluidity, I think Euler as well had Euler Swap, which is kind of merging of lending protocols with their humongous pools of capital that has nothing to do, that you cannot do anything with that pool of capital. Now you can use this to swap or to use this to supply liquidity, or you can have the integration to AMMs. That's kind of where the next layer of capital efficiency comes in. You have more use cases for the same pool of capital.
How customizable is Panoptic V2? Is there a standardized vault per asset that you just have to kind of self-calculate your desired exposure to? Or can you take your uni LP position, regardless how concentrated, regardless the like range, regardless the asset, and can you use that to find your customized perfect solution on Panoptic?
Yeah, so you can do both. The Uniswap LP holders, they come in with their own range, they come in with their own parameters, and they will have to kind of look at the existing liquidity if they want to hedge this or kind of use this as trading. We had a migrator contract that allowed you to move your liquidity from Uniswap to Panoptic in one click. And then once it's there, you can imagine hedging or kind of even doing you can buy protection against impermanent loss, for instance, with your LP position. So anyone can do anything they want in terms of which options they want to sell. There's a network effect that happens as well, that you don't want to have too much liquidity in too much places. So we standardized a little bit the options strikes, the options expiries. So we offer 0 DTE, weekly options, monthly options, yearly options. We even have hourly options. You can even imagine like 5 minutes prediction markets. The UI guides users towards a specific set of timescales, and that's translating to different widths of your LP position. But also the strikes that you create also has kind of a tick spacing that's wider than what you have on the Uniswap. So it's a bit of both. We do hope that people come in with their capital and trade natively on Panoptic. It's still LPing in Uniswap, but then you have all of the capital efficiency gains by having all the capital in the same place, as opposed to start with a Panoptic Uniswap position that lives in your wallet, and then you have to have some capital on Panoptic to hedge it, and you cannot use the LP position as collateral directly unless you migrate. So again, the best way to take advantage of Panoptic is start fresh, pretty LP position, start a new one with that kind of standardized set of strike.
To what extent would you say are the new sources of yield generation that Panoptic is unlocking coming with more friction from the current ones? Because I would say we can go through your article that you published yesterday in a few minutes, but one trend in DeFi that I have seen is that all the kind of more accessible and standardized ways of yield generation, Pendle has become very mainstream. It's just leading to a consolidation of yields. The Avefina loops are getting standardized through various vaults. So it is very hard to really find above market rates in these fields. And where you're seeing more friction, where you have to be more attentive, where you have to be more knowledgeable about like sleuthing on chain, identifying DPEGs, etc., or any divergences before others, it's just getting much more professionalized and much more competitive. And basically, if you're somewhat of a active but still like a normie yield farmer, you're basically just competing against like Chut.eth, CBBOE, and maybe 50 to 100 people from YAM, and they're taking away all your yield. So is a Panoptic kind of introducing new verticals that kind of democratize yield again? Or would you say that this is a tool primarily reserved for professional yield farmers who actually know what they're doing?
Yeah, so we can recap a little bit, but you've done it well about the current state of DeFi. And again, I wrote an article as well yesterday about these ideas, but the DeFi works as intended. You have composable finance where you can borrow an Aave using PT token from Pendle and kind of tokenizing Ethena. So all three protocols, they can interact with one another. No one needs to ask for permission. You can just tokenize and use this as collateral. So within the protocol, it's great. That type of trade, the basis trade from Ethena, is tokenizing a strategy. And then you can build on top, which is great. And then Pendle is a master of tokenizing, of like commoditizing the yield and making it tradable. Aave and Morpho are masters of making that yield work for you, and you can use it as collateral. And all of this works as intended. And this is a great kind of accomplishment almost. Like the fact that it's so maybe juiced out, or so many people are doing it and there's no more opportunities, means that it's now quite efficient. You can expect the yields on Ethena will be exactly what they are, and the yields on the different protocols will be exactly where they are. So this is great. And I did this is working as intended. You see a similar type of structure in TradFi, and yeah, it's juiced out. You or me cannot initially expect to make money out of this because you have billions of dollars making this efficient. The point that this article is making, and also that the options world is making, is that when it becomes efficient on the basis trade, there's nowhere else to go. Athena could try to say, okay, we're going to tokenize the BTC basis trade, maybe Solana, maybe ETH. But at some point, it's the same trade that's repeated, and the same inefficiency will be armed out, and the same outcome will be, hey, it's quite efficient. There's no room to grow unless there's more assets to grow. And
What
this
would you
is
say are the base inputs into DeFi yield right now? It's probably like there's treasuries, tokenized treasuries, and the basis trade. Then there are swap fees, so either through orbs or through LPing, and then there's fees generated from lending. But I would say that these three are the main ones that are a little more mid to long term sustainable, I would say. I mean, basis trade obviously depends on market and risk appetite. Treasury yields depend on rates. So these fluctuate, but there is going to be like some venue for them. And I would say the more speculative one that has subsidized a lot of the DeFi yields over the past 2 years almost are all of the points programs. And particularly if you're looking at the PTs on Pendle, there have been times where you've been able to get 20, 30% on these things, and it has been solely propped up by point speculation. And I do think that the market has become much more cynical about these points programs, new token launches. So we are all very desperate in search of a new long-lasting yield source that ideally is also composable again, and you can kind of build all of these DeFi Legos around it. So why are yields from options particularly suitable to fill that gap?
Yeah, exactly. And then the we can also draw from TradFi, but the key point is that with options, it's a different story. Again, the Athena trade tokenizes who wants to go long an asset, and then you supply the liquidity, and that is earning 3.5%. In options, there's many players, there's many instruments, there's many expiries, there's many strikes. You can think of the Athena trade tokenizing a single market, which is the purse market. In options, there's dozens, if not hundreds of markets similar to this. And because it's a surface, it's a lot more broad in terms of the extent to what it does. A single pair ETH-USDC can have thousands of markets on top. And you see this even with the IBIT ETF. It's fragmented, it's inefficient, it's may seem like disparate in terms of what you can do, but because there's so many use cases, you can always find a different yield source. You can tokenize one type of strategy, Athena style, and not step on anyone's toes that tokenizes a different strategy. And the volatility that you trade, the time structure that you trade, like the smile or the way that the volatility changes with price, all of those needs to be arbed, all of those needs to happen. And many actors do it. In TradFi, you have Susquehanna, Jane Street, Citadel, a bunch of also lesser known entities, but they all trade options. They all make a lot of money with their own niche. And it's a service that's needed. And if you think about this, by the time they have made the ARB efficient, and by the time there's no more juice left, if you want, in that trade, that means it's efficient. So traders can come in and now trade at a very fair price, tight spreads, very, very efficient market. And there's going to be 5 more opportunities for yield if you kind of go down the stack for different expiries, different assets. So the ceiling that we've hit to some extent is because there's nowhere else to go for these Athena-like basis trades. The next layer is options because of the diversity, but also the absence of a ceiling. And this is maybe me pushing the argument again here, is that there's never, it's going to be quite hard to run out of strategies, because TradFi, which has 4 decades of experience, has not run out yet. And then they've run out of the basis trade decades ago. They've not run out of strategies for options trading for 4 decades. So similarly, opening up the options market just generates more opportunity. It's a more complex product. It's simpler to go 100x on a meme coin on Hyperliquid than try to buy call options. But for those that do market making, those that do prop shop trading, they know these opportunities, and they will kind of lean into them. So with Panoptic, we open up that option side. And in a way, it's way, way more rich in terms of value creation than just betting on the price going up or down. It's the whole kind of cottage industry of arbitrageurs that can make the whole system and can efficient. And if you think about this, Uniswap, LP positions, everyone do their own thing. They choose their own range. It's all kind of not even, you don't compete with anyone. You just kind of want to put your liquidity there. But now when someone can buy your liquidity, when someone can actually compete with you and kind of generate a more liquid market, then you have more opportunities. The way that I'm trying to frame with this article, the future of options is that it's a new way to tokenize strategies. It's a limitless, boundless market in a way, because we won't run out of things to edge out with options.
Why would you say the time for options in DeFi is ripe now? I mean, options have been talked about since, let's say, 2021, 2022, the latest, yet all the options protocols so far have not succeeded in getting any lasting mass adoption. So what has changed by now, and how do you also view your competitive landscape? Is it more synergetic if you're looking at Derive and all of the other ones around, or is it kind of all competing over the same market and the same type of user right now?
Yeah. And again, even Open probably had the contracts live by 2019. At a conceptual level, an options protocol is maybe more complex than an AMM, but it's not that complicated. You have a strike, you have an expiry, an oracle feed for the time and the price, and it's straightforward to implement. It's and if you've been around, like it's like Ether Delta and DDEX before Uniswap came along and EMMs. In a way, the skeuomorphic options, the skeuomorphic approach is to take the options chain that you see on Deribit, you see on the CME and the SIBO, and put this on chain. But because you use the exact same way to translate, it's an order book. If you try to do an order book on chain, we know it's difficult and you need kind of speed, and kind of Hyperliquid made it free to cancel orders. You do need to do tricks to make order book on chain work. Now imagine 1,000 order books for the same asset. ETH USDC has 100 strikes, 15 expiries. Any price move requires you to update the price of all of them. You have to sign 1,000 transactions every block to just make sure your quotes are aligned. And that's why you need to go to layer 2s. You need to go to your app chain. It's not a sustainable way to do options because the complexity is quadratic. You have a lot more markets to manage. And what I said, again, with Panoptic, we create an AMM-like instrument for options. Not the pricing is an AMM, but we reimagine how options trading works. The same way that AMMs reimagine how swapping works. Binance and Uniswap, you swap, same end user experience, but the guts of the protocol is quite different. One is order book, one is automatized. We've been working on this for, again, 2021 was my first protocol, so we're approaching 5 years. It's a tough problem. We do feel we cracked it because it's working. V1 made it, demonstrated as it's a working product. V2 makes it now easier to trade, easier to commoditize these strategies. But yeah, I think the tech is a big hurdle. Could go faster chain, maybe you can make it work, but whether it's mainnet or even layer 2s, it's quite hard. And the second aspect of it is that if you want to tokenize stocks, if you want to tokenize equities on chain, you want to trade Tesla stocks on Arbitrum or even Ethereum mainnet, yes, you can swap, but then a lot of the use cases for trading stocks is also options trading. You want to be able to get sell calls against it. You can want to be able to be directional. The option stack needs to be prepared and ready for tokenization, because the sophisticated players won't even touch on-chain trading if they cannot do options. They'll stay on their Blueburn terminal in a way. They'll stay where they are comfortable with because they're going to see this huge piece of the puzzle missing, which is, hey, how do I hedge? How do I create the strategies that I've known and used for decades on-chain? So in preparation of this mass tokenization events, we do also have to have a functioning and efficient options layer on top. And that's also where we come in as well.
What can we expect from the launch of V2? And maybe you can already hint when we can expect that launch. Will it be cross-chain composable? So will you be restricted to ETH1, or can you like hedge and deploy across ETH1, Solana, Hyper EVM, etc.? And since you were already talking about RWAs, how are you positioned to adapt to the change in assets that are available to trade in crypto? I mean, most importantly on ETH1, Solana, but also Hyperliquid coming up with a lot of commodities markets and tokenized equities markets.
Yeah. I mean, the launch of V1 is very, very near. The smart contracts and the audits were the main concern because we want to take seriously, of course. 2 weeks ago was when we got the final report from Liquidity Arenas. Contracts are done. The UI is done. We're in testing phase. So very, very soon, matter of weeks, I guess, we should be live. We will focus on Ethereum mainnet. And this is also almost like also planting our flag in the ground that we can make options work on mainnet, then we can make it work on any chain. Hyperliquid, of course, app chain layer 2s, but we want to make it work on mainnet first. And the first products that we'll release will be these tokenized strategies that we discussed about. Gamma scalping, covered call writing. You can even imagine like a volatility harvesting vault. All of these strategies, when we build V2, are integrated in the protocol, so it's quite easy to run them. Anyone can run them. You can think of like even Morpho's model where you have curators that do different strategies, and retail users will deploy capital to the strategies. If you want to trade themselves, buy their own options, it's also available. But the funnel for users will be, what do you want to express in terms of volatility, profile? There's a vault for you. And one example, the gamma scalping vault that I mentioned earlier, is that gamma scalping is a strategy that works in TradFi. You buy an option, you hedge this continuously. The price you pay for that option is implied volatility, which is a different number than the realized volatility of the asset. And if you're lucky, the price you paid is low and you have more realized volatility, meaning that you have a higher return when you do gamma scalping. And that strategy you can run even on your Robinhood account if you want, but it's quite accessible. I would suggest that people start doing that type of strategy if they want to get into options trading. And the yields are compressed. It's similar to Athena basis trade. Everyone does this. Funds do it at scale. You can come in and do it at smaller scale, but probably get 10%, 15%, depending on the assets. And it has to be epoch dependent. Sometimes IV is elevated. You don't want to buy options. Maybe it's low. So there is some finesse to it, but it's a valuable strategy that you can do on your Robinhood account quite easily. And we have a vault that does this. Now we manage the rebalancing, we manage the hedging. And the key point is that since we're the first ones to do it in a way, it's quite profitable. We will share backtests. There's even an article that's coming today about this, but the edge that you get doing gamma scalping in TradFi is razor thin. The one you have doing it in DeFi is quite juicy. And we do expect that to be a unheard of in terms of yield, given the current market, which is like 4 to 5%. So that is one of the key strategies that we expect to deploy, gain traction, make it so that it compresses. But once it compresses, then now you have an efficient market in that type of strategies. And now you can build on top. So vaults will tokenize these strategies, will make them easier for users to onboard and kind of be exposed to it. Similar to a covered call vault, you have covered call ETFs. These serve a purpose that's distinct than buy and hold, but they also serve a purpose. So the vault will be where we have a lot of the onboarding. And all on mainnet, we can launch on all layer 2s. We can launch on Hyper EVM even. Solana is a bit difficult, but again, the goal is to also have the presence be everywhere. It's a core primitive. So when we have lending protocols, everywhere you have a chain, you'll feel there's going to be a Panoptic-like options protocol wherever you have a chain. We do want to make our launch focus on mainnet, but yeah, we do have plans to expand to all the chains.
What are some very simple and straightforward strategies that people can deploy on Panoptic V2, just for those among us who probably understand now the basic workings of options, but haven't been super familiar with underwriting options themselves and are not seasoned options traders? Like, how can they start getting exposure and get deeper into the rabbit hole over time?
Yeah. So I think with V1, we did a lot of education efforts. We were doing live streams as well. I was teaching Rosalie, a woman for marketing, how to trade options. So no math background, no finance, but she was quite good at it. Like you have to follow your guts. You just have to know what to trade. But then we figured that it did take a long time. And unless you're ready to put in the effort, which is maybe like an hour a day sometimes, but then it's quite hard to be successful. And if you walk away, you can get wrecked. So the vaults is our main onboarding method for these passive users. But if you want to be trading yourself and you have a good kind of plan in mind, gamma scalping that you do on yourself, on your own, is definitely fine. Some funds do it every day at noon. I hedge. And you can do this if you eat your lunch, say, all right, I'm going to hedge my positions. And that's a quite easy, like straightforward thing to do. And that is kind of at the core trading volatility. It's a very options like trading instrument, trade volatility. You bet on the volatility going up or down without having you to understand a lot of the Greek. So gamma scalping, reverse gamma scalping is another one where you sell options and then you hope that the implied volatility is going to be higher. But it's a very mechanical process. You look at your positions. Do I need to short a bit, go along a bit? Because we're in Panoptic, you can short in protocol. You can go long in protocol, so it's quite easy to do. But yeah, the and if you want to be directional, there are different ways. But at least in a systematic way, where you want to be doing something that was not going to liquidate you too often, being delta neutral, being hedged is the best way. Our goal is to have you have your whole portfolio, you have LP positions, you have holdings. You can also hedge this and say, hey, I don't want to lose more than 5% during a drawdown. You can also buy options for this, but this is maybe a follow-up product we'll launch soon as well.
Very nice. So since we're close to hitting the hour, what does your roadmap look like for 2026? Which other features can we expect? And have there been any topics you'd like to discuss that we haven't covered so far?
Though we've covered quite a bit, but yeah, in terms of what we expect is that launch on mainnet, Vault will be the core focus for users that want to get exposure to options without having to learn and read textbooks about options pricing, which is going to be a huge unlock. And there's been decentralized options vaults in the past, but it was one strategy and you had to deal with a unknown counterparty. In our case, the strategies will evolve and then it will launch a strategy and then you can have a different strategy that will coexist with it. But then any user can also do it on their own or interact with that liquidity. So it's quite a bit of a it's a feat to have all of that be versatile enough to run any strategy. So this is going to be where we expect new strategies to pop up every month or so to kind of stabilize on the meta of the market. We do want to create a one-click hedge your portfolio product. If people see price going up, everyone is a genius. If it goes down, then you feel bad. But if you had some protection, which is what risks are all about, then you can make it easier for users to shoulder the 15, 20% risk that drawdowns we see every once in a while. And yeah, we do have ideas for back testers. We want to make it so that people can run strategies on an SDK. You can run this kind of on your own computer. The SDK is already live, but then we do want to create more examples and make it even easier for people to run these strategies. Personally, hedging the part, I said earlier, you can do it every day at noon, but sometimes you do it on a threshold based. And if it happens at 4 a.m., you may not see it till you wake up. But if you have a bot that just does the hedging, then you can catch these events that happen when you're not around. So just making the strategy management a bit more efficient is another one of it.
I'm definitely looking forward to the launch and quite excited to try it out. I have not yet bought or sold any options in DeFi. So yeah, interesting to see if we'll finally take off with options. Guillaume, thanks a ton for coming on. I think that was a great conversation with one of the OGs in the LPing and yeah, liquidity provision space. Where can people find you? How can they reach out and work together with you at Panoptic?
Yeah, for sure. So I'm on Twitter a bit, getting sometimes into big arguments about LPing. That's what I do. But my handle is GUIL_Lambert, LEMBRT. You can follow the Panoptic protocol, Panoptic_XYZ on Twitter, and also join our Discord. Very excited. People have noticed the SDK published this without even advertising it, but then people looked at it and already have questions. So it's a good sign people want to run these strategies. And yeah, I think overall, reach out to me even on Twitter. I can respond. But yeah, anything that you want to build, anything that's AMM related, even if it's a question about your own Uniswap LPing, more than happy to help you.
Sounds great. As a last question before I let you go, which are 2 people or 2 projects you'd like to see on the pod over the next couple of weeks?
I haven't been paying a lot of attention outside of my little options bubble. Again, I don't know if you can, in the options world, one big thing that happened is that Coinbase now kind of moved in the options world by acquiring Deribit, which is a huge user acquisition. They own the largest options exchange. Binance doesn't even have that. So that's a huge win. But also at the same time, they've acquired the open team, which is the team behind Squeak, between the open protocol. Like they do have a clear roadmap for them, which is options is the next big thing. So you may be able to get someone from the open team if Coinbase allows them to talk about their journey as well. Again, they've struggled unfairly with CFTC, but they did also were the pioneers. I think Squeak was a fantastic product. So that would be a good one that to hear the context and the future of options and kind of what they do at Coinbase. But yeah, another one that I've liked as well is an app called Euphoria, which is a tap trading. It's aimed at retail. It's on Mega ETH. It has a lot of potential for distribution. I like that they made options. It's options, but you don't know about it. But it's made options accessible and easy to trade. Haven't tried it out myself, but from what I hear, someone can also lose quite a bit quickly. So it's easy to get carried out, but it's actually a very good, innovative product. I'm happy to see this also be kind of democratized options access as well.
Perfect. Thanks a lot for these suggestions. And yeah, I hope to have you back on the show once V2 is live and we can all walk through the platform.
Perfect. Yeah. It was a pleasure, Max.
Have a good one.